So you've probably never even heard of Parker-Hannifin, but I guarantee their parts are inside almost everything that moves around you. Today, we're going to dig into how this quiet industrial giant pulled off a really stunning transformation, and what it all means if you're an investor watching from the sidelines. You know, this is the million-dollar question for any legacy company, right? How do you avoid becoming a dinosaur? Well, Parker-Hannifin's story is this fascinating blueprint. It shows a major shift from a business that was just totally tied to economic cycles to something, well, something far more durable. Let's start with what the company used to look like. So, to really get a handle on where Parker is today, we have to understand what it used to be. For decades, it was a solid, totally respected industrial manufacturer, but, and this is a big but for investors, it had one major vulnerability. Its performance was completely tied to the ups and downs of the global economy. Okay, so here's the before and after. On the left, you've got the old Parker, a classic cyclical company. When the economy was roaring, they did great. When we hit a recession, their earnings could just fall off a cliff. But the new Parker on the right, that's a different beast entirely. It's been engineered to be more resilient, way more profitable, and a real leader in high-tech sectors. So the big question is, how on earth did they pull this off? Look, this transformation didn't just happen by accident. It was a deliberate, multi-year strategy, and it really boiled down to two key things: a unique operational playbook and a series of really smart, game-changing acquisitions. Let's start with that playbook. At the absolute heart of everything they do is something called the win strategy. Now, I know it sounds like a bunch of corporate jargon, right? But think of it as their secret sauce. It's a decentralized playbook that empowers local managers with the tools to cut waste, improve safety, and hit very specific financial targets. This relentless focus on just getting better and better, repeated across hundreds of facilities, that's the real engine behind their ever-expanding profit margins. It's their competitive moat. And here's the second part of the strategy: smart acquisitions. You can see a really clear pattern here. Each deal was a strategic step into higher growth, higher margin businesses. But the one you really need to focus on is Meggitt in 2022. This wasn't just another buy. It was a landmark deal that fundamentally altered the DNA of the company by massively, I mean massively, scaling up its aerospace division. Okay, so the strategy sounds great in theory, but for us as investors, we have to see the proof in the numbers. And let me tell you, the financial results that followed this transformation are, frankly, stunning. Now check this out, because this is the dramatic portfolio shift in action. Look at that aerospace slice. Before they bought Meggitt, it was just 16% of their sales. Today, it's nearly a third of the entire company. And this is so important because aerospace is a long cycle business with super profitable aftermarket sales, repairs and spare parts. It provides a powerful, stable counterbalance to their more cyclical industrial side. And here is the payoff. This chart shows their adjusted operating margin. In simple terms, that's the profit they squeeze out of every single dollar of sales. You can just see this relentless climb from around 14.5 cents on the dollar to over 26 cents. That is a direct result of the win strategy and that big shift into more profitable businesses. For an industrial giant, that kind of margin expansion is truly best in class. Let's just pause on that final number for a second: 26.1%. This isn't just a record for the company. It's the ultimate proof that the new model works. The crazy thing is, they hit this peak profitability even when the global economy was pretty shaky. That's the clearest sign you can get that they've finally broken free from their old cyclical patterns. And all that profitability, it generates an absolute torrent of cash. Now, for investors, profits are one thing, but we all know cash is king. In just 1 year, the company generated $3.4 billion in free cash flow. That is the actual cash left over after running the entire business. It's what lets them pay down debt from those big acquisitions and reward their long-term shareholders. And speaking of rewarding shareholders, just look at this number: 69 consecutive years of raising their dividend. That level of consistency is only possible because of the incredible profitability and cash generation we just talked about. It puts them in this very elite club of dividend aristocrats, and it shows a deep, deep commitment to shareholder returns. Okay, so the transformation is a proven success. The numbers don't lie. But as an investor, your focus is always on what's next, right? Where does the next phase of growth come from? Well, the company has positioned itself right in the middle of several powerful long-term trends. See, the company's future growth isn't about just waiting for the economy to get better, it's about plugging into the biggest technological shifts of our time. Think about it. Electrification, clean tech, automation, the ongoing aerospace boom. Parker's components are critical for all of them. And that huge aerospace backlog alone, that provides years and years of predictable revenue.
And you should know, management is not resting on its laurels. They've put a really clear target out there, a 27% operating margin by 2029. And given that they just hit 26.1%, this isn't some pie-in-the-sky dream. It's a credible goal that shows they have a clear plan for continued improvement, driven by that powerful mix shift and ongoing efficiencies.
All right, so we've established that Parker-Hannifin is a high-quality transformed company. This brings us to the ultimate question for any investor, which is, what's it worth? And is it a good buy today? And this, my friends, is where the debate really begins. Understanding both sides here is absolutely crucial. The bulls are going to tell you the market still doesn't fully appreciate just how resilient this new model is, and that as long as they keep executing, the stock will go higher. The bears, on the other hand, they'll point to the stock's premium price tag and argue that it's basically priced for perfection. Any stumble or major recession could hit the stock really hard. So let's put that valuation into context. We're looking at the forward PE ratio, which is basically how many dollars you're paying for $1 of expected future profit. At 26 times earnings, Parker definitely isn't cheap, but it's right in line with its top peers. But now look at that margin column. Its profitability is higher. And this is the core of the debate. Investors are willing to pay a premium price for Parker because it delivers premium-level execution and profits. And really, that's where we have to leave it. There's just no doubt that Parker-Hannifin has pulled off one of the most successful industrial transformations of the last decade. They have built a more resilient, more profitable, cash-gushing machine. The only question left for you as an investor is to decide whether the market has already figured all that out.